What about the other way round, when directors actually have taken too much out of the business and owe the company money? How do they deal with a situation like that?
Yeah,
Tax planning.
sadly that happens quite often with clients. Normally it's because they're taking a regular amount out each month, thinking they're dividends. And then we get to the end of the year and say, actually, the profit isn't as good as you thought it was. And now we have to reverse some of those dividends and treat them as loan withdrawals, and therefore create a debt from them to the company. The first thing is, it's not the end of the world. If you've got a good business and you can either grow it or cut the amount you're taking out, you can work your way out of these things. Tax-wise, there's two taxes that come into play if you've got an overdrawn loan account. One is that you pay a benefit in kind charge, which is a deemed interest against that loan account, if the amount is over £10,000. If it's under £10,000, there's no deemed interest charge, which goes in your P11D. Alternatively, you can actually pay into the company the equivalent interest and not have the P11D charge. But I don't have many clients who do that. And the other thing is, if your loan is still outstanding 9 months after the end of the accounting period when it was created, then you'll have to pay something called a bond to the government under Section 455. And that's calculated at the higher rate of dividend tax. So dividend tax is 33.75, currently going up to 35.75 after April. And the issue there is that bond is paid to HMRC. HMRC hold it until you start to repay the loan. And you don't get it back until 9 months after the accounting period when you've repaid some of the loan. And then you can claw back the bits that you repaid. And that causes a big cash flow issue, as you can imagine.